What's up, everybody? This is Lamin from investingsimplified.net. Today is Saturday, August 28, 2021. Welcome to our weekend market analysis. Today, we will take a look at market sentiment. We will listen to Fed Jackson Hole's speech summary. We will take a look at ES, NQ, dollar index, TNX, and wrap up the review with Bitcoin. So with that, stay tuned for more detail.
To sum up, the baseline outlook is for continued progress toward maximum employment, with inflation returning to levels consistent with our goal of inflation averaging 2% over time. The early days of stabilization policy in the 1950s taught monetary policymakers not to attempt to offset what are likely to be temporary fluctuations in inflation. Indeed, responding may do more harm than good, particularly in an era where policy rates are much closer to the effective lower bound, even in good times. The main influence of monetary policy on inflation can come after a lag of a year or more. If a central bank tightens policy in response to factors that turn out to be temporary, the main policy effects are likely to arrive after the need has passed. The ill-timed policy move unnecessarily slows hiring and other economic activity and pushes inflation lower than desired. Today, with substantial slack remaining in the labor market and the pandemic continuing, such a mistake could be particularly harmful. We have said that we would continue our asset purchases at the current pace until we see substantial further progress toward our maximum employment and price stability goals, measured since last December when we first articulated this guidance. My view is that the substantial further progress test has been met for inflation. There has also been clear progress toward maximum employment. At the FOMC's recent July meeting, I was of the view, as were most participants, that if the economy evolved broadly as anticipated, it could be appropriate to start reducing the pace of asset purchases this year. The intervening month has brought more progress in the form of a strong employment report for July, but also the further spread of the Delta variant. We will be carefully assessing incoming data and the evolving risks. Even after our asset purchases end, our elevated holdings of longer-term securities will continue to support accommodative financial conditions. The timing and pace of the coming reduction in asset purchases will not be intended to carry a direct signal regarding the timing of interest rate liftoff, for which we have articulated a different and substantially more stringent test. We have said that we will continue to hold the target range for the federal funds rate at its current level until the economy reaches conditions consistent with maximum employment and inflation has reached 2% and is on track to moderately exceed 2% for some time. We have much ground to cover to reach maximum employment, and time will tell whether we have reached 2% inflation on a sustainable basis.
Okay, folks, before we take a look at charts and sentiment, as the chair just stated, they have two mandates: maximum employment and price stability. Their objective on the inflation portion, they have reached that, according to the chair in the summary speech. However, more work needs to be done on the job side. And we know that tapering is coming this year, contingent on incoming data. So we will continue to monitor the situation. Whether the tapering will be announced next month or by December, no one knows. We will pay attention to the job market and see if there is going to be anything that will change Fed's mind about reducing the asset purchases. So with that, let's jump to the charts and the sentiment indicators and see where the key levels are going into next week. Looking at the daily time scale of ES, as we can see here, S&P 500, the trend remain intact. Since we had this 10% pullback in September to October of last year, market has been grinding higher consistently. Although we had some minor pullbacks here and there, nothing major. So what is our strategy going into next week, and what are the key levels? Our strategy going into next week, we remain constructive in the market. Any pullback, first key level that we are monitoring is 44.75 to 44.60. If that level gets violated, the immediate support level will be 20-day moving average, this blue line here, which is sitting right around 44.41.36. And if that level cannot hold, then the 50-day will be the most important level, because has been the buying zone for us throughout this year, and the 50-day moving average is sitting at 43.70.2, this wide line here. If market pull back to the level, we will be biased until and unless something changes internally that indicated to us otherwise. However, if market continue to grind higher, the first resistance level 45.50, market back off that level and find sellers there, we will monitor that level. And if market break that level, expect this trend line to get tested, which is sitting right around around 45.75. So for ES, those are the levels we are paying attention to. Trend remains intact. No need to fight the trend in our opinion. RSI sitting right at 64, not overboard. So let's jump to NQ. Looking at the daily time scale of NQ, this is the Nasdaq 100, similar to S&P 500. Trend remains to the upside. The 4 key levels we are monitoring on NQ, 15267 to 15175. If market cannot hold that immediate support level, the 20-day, which is at 15122.51, and the 50-day 14861.79. Those are the levels we are monitoring. If market continue to grind higher, expect NQ to continue to grind towards this trend line here, which is sitting right around 15795, or just call it 15,800. How quickly market is going to get there remains to be seen. We'll continue to monitor. RSI sitting right around 65, not overbought. So let's jump to dollar index. Looking at the dollar index, I call this a confused market. It's like the dollar just doesn't know what it wants to do. It's up, down, up, down. Looking at this chart, in my opinion, we still remain this 93 to about 93.50 to about this 91.50 zone. Where the market is going, where the dollar index is going to turn around and go back up next week remains to be seen. We'll see. It's approaching a key technical level, the 50-day. If this happened to act as a support next week, let's say we find bias here, dollar index start to turn around, until we see a clear move away from the 93.50 level. It's just a chap. No clear direction on the dollar index, although looking at the weekly time scale, it appears that we have a clear breakout, but market is back testing again. And the back test, we fell back into the range. Whether we will find support at the 50-day and then market start to turn around remains to be seen. The dollar index is very, very difficult to make any call here. I really don't have any strong conviction which way dollar wants to go. All that I know is we're in a range, 93.50, 91.50. Unless we get a clear breakout to the either direction, I'm not ready to make any meaningful bet on any of the currency pairs yet. So with that, let's jump to TNX. Looking at the 10-year note, this is TNX, US 10-year borrowing note. As we can see, in our opinion, this is in a clear range. Lower end of the range, around 1.12, the potential, this support zone that was tested twice in mid-July to about early August. Market rallied. We found resistance right around the 1.38, 1.39 level. Market tested that zone twice and we are backing up. So the question is, are we going to continue to go low? Is this going to continue to come lower? Or market will turn around and blow through this resistance level and ultimately start to come towards this prior highs, which is right around the 1.75, 1.77 level. Remains to be seen. We'll continue to monitor on a day-to-day basis. We are getting a little bit concerned here due to the fact that consumer sentiment was pretty weak a few weeks ago, and if consumers start to back off, that will be reflected in yields very, very quickly. So we'll continue to pay attention to economic data and see how yields react on a day-to-day basis. But thus far, yields remain in a range, upper end of the range 1.39, lower end of the range 1.12. Until we get a meaningful break to the either direction, it's nothing to do here. A significant break to the downside favor tech. A move to the upside, you want to de-risk on tech and overweight value. So with that, let's jump to Bitcoin. Looking at the daily time scale of Bitcoin, as we can see here, since this correction, it appears the correction may have ended. However, there is no indication in our opinion for that yet. Most people are calling for a bottom has been put in for Bitcoin. However, since we have been rallying here, guess where Bitcoin started to struggle? Right around this breakdown zone. If Bitcoin start to struggle here and cannot get above this 50,500 and start to move towards this upper end of the range here and possibly take this prior high out here, in our opinion, the correction playbook still remains. This chart here, any break of this trend line, especially Thursday and Wednesday's low of this week, if those levels get taken out right around 46,350 zone, if we start to break that level to the downside, it might get ugly very quickly to the downside in our opinion. We don't believe this correction is completely over yet. We'll continue to monitor until and unless Bitcoin clear this all-time highs. We will be looking for opportunity where Bitcoin could potentially reverse this trend from up to down. So with that, we'll take a look at sentiment indicators and see if market is exuberant or pessimistic. Looking at the AAII sentiment index, as we can see here, as of August 25th, there were 39.6% bull and 33% bear. The average about 38%. So this is basically sitting right around the neutral zone. It is not telling us market is overly positioned to either direction, to the one side, either to the extreme or to the pessimistic side. So this is another reason why we are still constructive in the equity market. Understanding that tops and bottoms are sentiment based and psychological based, not fundamental based, we still remain constructive and we expect more room to the upside in the equity market, which doesn't mean that we will not get pullback. That probability is always there, but use those pullback as an opportunity to add risk. So let's take a look at intelligent investor sentiment. Okay, the final sentiment indicator that we will take a look at is the investor intelligence bull bear. As we can see here, the bulls as of August 24th, 50%, bears 18.5. This is the only sentiment indicator that is kind of creeping towards the high end. However, it's still a little bit below 65, so we'll continue to keep an eye on that and see how sentiment changes as we go into next week and the week after to see which way, if other sentiment indicators will be cooperating with what the investor intelligence is telling us. So with that, we'll end the review here. If you enjoyed the video, please give us a like, subscribe, and share with friends. We hope you all have a blessed weekend. Bye for now.